Joining me today is Malcolm Frank of Cognizant. Malcolm, welcome to BloombergQuint.
Thank you.
You have been in the news for some time with respect to engagement to investors. How far have you been? You came out with a little change in strategy with respect to dividend and cash payouts. Can you just take us through that?
Yeah, this is a process we've been going through for about the last year, building our Cognizant 2020 strategy. So we started to launch it internally in the company last year. And then over the fall, we had an investor, Elliott, who came forward and stated what they were really looking for as well in terms of our acceleration there. That process was actually, there's a lot of alignment in terms of what we were already planning on doing and looking to do with inside the company. So we announced it last week and really had several components. First and foremost is the acceleration of our strategy with our digital services for our clients, so helping them reimagine their capabilities, building smart products, virtual channels, building their whole new process infrastructure and their whole new systems infrastructure. So that was one piece of it, which is really central to it. But the second then is capital reallocation. And so it's the dividend that we announced, it's the share repurchase that we announced, and also our acceleration on M&A. So I think those are three components on the capital allocation program.
What about the top line growth? Many of the analysts are talking about that now you're going to focus on margins and growth instead of just a top line growth there. Is there a shift in strategy there as well? Because you're trying to target, 22% margins?
Yeah, I think there's it's driven by, again, the strategy. There's really two key components to it. One is the scale that we have now as a company. So from our IPO through last year, we had a very simple value proposition to investors, is that we are going to be the growth leader, we're going to have very consistent margins, and we're going to generate a lot of cash flow. It's a very simple formula. But now it's the time, as a firm of 260,000 employees, to start pulling the other levers for shareholders. And so that's what this program has been all about.
So you're also moving towards AI and automation to drive in that kind of synergies and growth in terms of margins and profitability, which your peer Infosys has also started. They also have a 2020 strategy. The IT industry is also going through a transformation, because now, I heard Vishal talk about that half of the jobs would go away because automation and AI will come in, and new jobs will be created in those areas. How do you see this transformation going through?
Well, I agree with the first part of that question, not necessarily with the second. So, look, the true north for us is our clients, and it's helping them with their digital needs. And so that's been, and the capital allocation program actually fits into that. So it is all about our three new strategies around our digital services and taking that to our clients. In terms of what that means for us, our clients are leaning on us to have those skill sets around data science, around Internet of Things, to the design capabilities to create entirely new customer experiences. When it comes to automation, our clients need it in their businesses around intelligent process automation. We're also seeing that being applied to our business. So is there going to be a transition? Absolutely. Will it be at the scale that I think some firms are describing? I'm not so convinced about that.
Is it going to be disruptive in nature for the industry as a whole? And of course for the clients, it will be disruptive in the way they look at things and do things. But for the industry which works on a shop floor basis, is it going to be disruptive for the industry in the next 2 to 3 years?
Yeah, our industry is unambiguously going through a transition, and we're transitioning from this model we had for the past 15 to 20 years around enterprise apps, the client server stack, systems of record, and moving now into digital. That is unambiguously occurring, and now it's occurring at scale. The key with that transition is whether it needs to be disruptive or not. And I think that's where it's going to separate firms in the next several years. Firms that are having disruptions, they're having internal arguments, they're having troubles getting from A to B, and others that are doing it rather seamlessly. And I think that is going to be what separates firms, those that have success and those that have challenges in the next 3 years.
So while you have the global economic challenge which is coming in as a headwind, you have new paradigm shift in terms of how various geographies like US is looking at with Trump coming in. You have automation, we have AI disrupting, and now you have proactive shareholders. So how is it all? How is the management looking at things like this? Because it's going to take a lot of management bandwidth to to satisfy those shareholders who are not going to be, which is not going to be easy for many companies, including you.
Right. Well, I think long term, look, our market opportunity has never been larger, so this digital opportunity is significant. So the firms that get this right are going to drive enormous shareholder value. The question is, which firms are going to do that? And it's those that navigate this transition as best as possible. And look, when you're in a static environment, we have to facilitate the needs of our customers, our employees, and our investors. When you're in a stable environment, firms can navigate those three and get them to work together fairly seamlessly. What you're describing is when we're in this transition, they get misaligned, and you start to see these sparks fly when you have that misalignment. That's what our sector is going through right now. And but look, we've got our plan. We're very confident with our plan that we can get through that as seamlessly as possible. A final point, when I hear people blame governments, I often think there's a bigger problem inside their company, because that has always occurred. We always have, whether it's changes with technology, changes with the economy, changes with legislation, those are always going on. And we've lived through years where we've grown 20, 30, 40% when those issues were as significant as they are now.
So you came out with a 7 to 10% band with respect to guidance. Is that a conservative thing? You've been very conservative in it? Or because Cognizant used to be very aggressive in its guidance. There is a transformation in that as well. So what's the reason why you've been very conservative now? Is the environment so challenging that you want to be wait and watch on the fringe before you take that aggressive stance again?
Yeah, well, our guidance, we feel comfortable with our guidance. Our guidance is what our guidance is, and we feel good about it. Another way I can characterize it is 2016 was a difficult year for us, particularly the first quarter. And so the first quarter, we had some negative surprises with some of our clients. We had to bring the number down, and then we were chasing that number the rest of the year. So our first quarter of 2017 is much more stable. We feel much more comfortable about it. So we're off to a better start this year than we were last year. But in terms of the guidance going forward, we're just going to have to see what the year brings.
How's 2017 looking for you as we go into it? Because almost 2 months into the year, you still think it's going to be a little slow and steady growth, or is it going to pick up in the second half?
It's a good question. Look, we're sticking with our guidance, so it is what it is at this point. But to date, things look very stable across the entire portfolio, meaning all of our industry groups, all of our geographies, and in particular this shift to digital. So I think the big beta for us is how fast digital accelerates.
How big is digital for you in terms of revenues as of now?
It's about a quarter of our revenue. So in our last call, we said it was 23% of revenue, and it's certainly going to grow faster than the rest of the portfolio.
And that would become a big chunk going in the next 2-3 years as more companies adopt digital and automation. That's what you're saying?
Precisely. And so what we're seeing is with our clients across financial services, healthcare, manufacturing, retail, as recent as 18 months ago, 2 years ago, digital, it was an experimentation. They would have some pilots. They would test it out, see how it would work. Now they recognize it's to give not just competitive distinction, but competitive parity. They have to do digital, and they have to do it at scale. And so you look across our retail banking clients, how do they deal with robo-advisory? How do they deal with virtual channels? What is the role of the branch in a 24/7 virtual digital environment? So these are the issues we're helping them with. And they're no longer elective. They have to do them at scale. So for our revenue and our revenue trajectory, it's just how fast does that accelerate? And because it's new, we don't know that yet. I don't think anybody fully understands it yet.
Are you also moving from an offshore model to a nearshore model as more and more countries are getting very protective about job losses and creation of more wealth within the country? Trump has been talking about how jobs should be created in India with respect to in US with respect to the kind of work they do there. Are you also looking at that shift happening for the industry and for you?
Yes and no. So where I say the no is, look, our footprint, I think, over time is going to be fairly stable. But digital is clearly driving more client need to be local. So if you look in the United States context, last year we hired more than 4,000 local associates. We've got a number of centers across the U.S. in places like Chicago, Dallas, in the New York City area, Iowa, North Dakota. We're going to continue to build those out. But it's really driven by client need. As clients are going digital, there's certain types of work, you have to be close to them to reimagine and re-implement entirely new processes or customer experiences or turn dumb products into smart products. A lot of that work has to be local, and so it's really driven more by the client than it is driven by legislation.
Malcolm, finally, there's a US probe going on with respect to expansions in India. What's the status of it, and is that taking away a lot of bandwidth and expansion plans for India?
Yeah, so we gave an update on the call last quarter. So, look, we're making progress. The team has been very thorough. This was an issue that we recognized it ourselves. We self-reported. It went to the audit committee. We've been very open about what's been transpiring. But no, at this point, we feel terrible about it. We feel horrible. We should have zero tolerance on these things. We took as aggressive action as we could internally once it occurred. So we don't feel good that it happened, but now that it's occurred where it is in the process, we're feeling fairly confident that it's contained at this point. But
when do you expect the closure from the US probe, actually?
Yeah,
it's going to be overhang on the stock.
These are things that you have to look under every stone. We have to continue. We just have to let the facts lead where they will. But so it will be an ongoing process, and so we're just going to see where it leads from there.
Thank you, Malcolm. Thank you for joining us on BloombergQuint.
Thank you very much.